Hi, everyone. I hope everyone is doing well and had a good day. So feel free to go ahead and ask questions. I see there's a few in there already. So when you have a day like this, it can be really upsetting. There's the issue. It can be really upsetting when you have a day like this, and I see some of the content, the comments, and the feeling I'm getting from some of the comments is, how can a day we've had so much disappointment, so much trading range price action over the past couple of days, couple of weeks, and all of a sudden we get this big breakout. How can that be? How can the daily chart have all of this right here? We just get this tight trading range and eventually a bull breakout. And the reality is, when you're in a trading range, there's one thing that is just really, really certain. And that one piece of certainty is that you're going to get a breakout. You're going to get a breakout up or down. Everybody knows it. It's kind of like I always try to relay back to things I would hear Al say in the trading room, but he would say a breakout's kind of like, when you're in breakout mode, it's similar to, if you ever watched a race, back in the day, they would have, the guy that he would have a gun in the air with the blank round. And as soon as the gun goes off, the swimmers jump in the water, or the race begins and everybody, races to the finish. And that's kind of how a breakout is. You don't know when it's going to happen, but when it happens, it could be really, really quick. Whenever you're in a trading range, this breakout really wasn't super big. I mean, the range was bigger than most days, about 50 points compared to yesterday, which was maybe 20 points. But what's important to realize in a trading range, we can see it pretty clearly on the Globex. You go to here's a 60-minute chart, and when you're looking at this, it's been interesting over the past couple of days just watching this trading range, because it's almost kind of like which bar is going to lead to the breakout. One of these is going to work. Which one's it going to be? And you see the range get tighter, and it's coming, but you don't know, is it today? Is it tomorrow? Is it the day after tomorrow? Is it next week? But it'll happen. And eventually, it's never clear. But then you start to get, here's a few bars up, then a bear bar, then a bull bar, and then another bull bar, and then boom, everybody gets trapped and you race to the upside. And you always have to be prepared for these situations, because what happens is, think about every trader to the left. So if you're a bear, I'm going to use this line as kind of a visual, but somebody sold the high of this bar right here. Somebody sold this support level. Somebody sold here. Somebody sold here. Somebody sold up here. And then you get that. And now it's breaking above everything to the left. So to me, when I look at this, I say, yeah, it's pretty significant. We're probably going to get a second leg. So the question is, how deep is the pullback going to be? But so far, it looks pretty good for the bulls. Now, we can't forget, this is the 480-minute chart. It's basically a daily chart, but It's just easier to type numbers on the keyboard than go to the daily chart, but it's 2 legs up. So is this going to be a second leg trap? I don't know. What I do know is when I look over here, this is around May the 1st. And my concern with this area is, let me see if I can actually, I can't go further back to the left, but the point I'm making is my concern is bulls got trapped right here. So you had bulls who bought in this area and scaled in lower. And because of that, this line is where a lot of those trapped bulls will sell out of longs and bears will short. So when you're in a trading range, which we are on the daily chart, until there's a clear breakout, there is no breakout. So back to the daily chart. What am I going to say about tomorrow? Well, I want to see the follow through. What's tomorrow going to look like? Is tomorrow going to be another strong bull trend day? And will this be a second leg up? Leg one being May the 1st, deep pullback to May the 4th, and then a second leg up. Are we going to get above the February 2nd high? We might, but yeah, it's a good bar yesterday, but show me more. Show me, if prove to me can the Bulls prove to me that tomorrow is going to be another strong bull day? Then I'll be impressed. But this, good for the Bulls, but they need more. So as always, here is the prior day. One of the first things I always do is I take the high of the prior day, in this case Tuesday, and I take the low of the prior day, yesterday's low, and I mark it. I mark it here, mark it here. This is the open of the week, which is really, really close to the open of the day. So I didn't feel like drawing 2 lines just because it would just be kind of distracting. So this green line, it's basically the open of the day. It's basically open of the week. If we form a trading range, maybe I'll delete the open of the week and draw the open of the day. But either way, first bar of the day, bar one is big bear bar following a gap up. And there's one thing for certain. We know that typically when you get a gap up, you get a second leg. So probably buyers somewhere in this area and the bulls will get a second leg up. That means a trend from the open on bar one is lower probability. Bar one is a decent bear bar, probably going to go a little bit lower. By the way, I want to give some insight. I'm going to turn this off. I want to share one thing really quick. Let me do this. So what I often do is when something, I'm going to share my screen in just a second. When something kind of catches my eye, I will often make a quick chart of it. So here is, I'm going to share my screen and I want to show the PowerPoint presentation for a second. And I think this is really important to do. So, I'll draw just several things that catch my eye. This was the Globex 60-minute chart. And if you're in a trading range, one of the ways to know you're in a trading range is you get big bars that traders fade. So if you big bull bar, if you sold it, you made a scalp. Big bear bar, if you bought it, you made a scalp. Big, weaker bar, but if you bought it, you made a scalp. Consecutive bear bars, even if you bought this close, you made a scalp. Big bear bar, if you bought it, you made a scalp. Big bull bar, if you sold it, maybe you made a scalp. 2 big bear bars, if you bought it, you made a scalp. Bull bar, if you sold it and you made a scalp, you get the point. But anyways, I'm going to show you how I create a slide really quick. So one thing that kind of caught my eye, I thought was interesting, is here's today. And I'm just normally I'd be a little more, I would make this look a little bit cleaner. But what I'll often do, if you have the video course, you can go to the bonus videos, 5 things to do every day. Al talks about, 5 steps that he practices, and he talks about how he'll, at the end of the day, he'll write up charts, he'll draw stuff. So what I'll often do here is I'll make a quick note at es.d in 5 minute. Also, I'll do the market, the time frame, and then the date, just in case I ever want to refer back to this chart. But to me, what catches my eye here is it was a gap up, and I'll usually change the name later, but I just want to make a reminder. So it was a gap up, expect second leg up, which means bad trend from open. And I'll clean it up later, but it's just a reminder that this is a bad trend from the open. And I'll just make a quick note here. When you get a gap up, expect second leg, which means bear ability. So increased the odds of the market reversing. So I'll just put like risk of, and then I'll just save it and I'll refer to it later. But that's an easy way to just document what you're learning or things that catch your eye. And that's really important to do because otherwise you can refer back to it later. So the longer, I've really spent more time than ever this year trying to make a lot of PowerPoint slides, and I really enjoy it. And it's really just kind of, I think it really just, it helps with just kind of the learning process. But anyways, we have gap up, bar one, trend from the open. Is it always in short yet? I don't think so. The bears probably need one more bar closing on its low. And there's a bear bar closing on its low. One of the things I thought was interesting, let me see if I can do this. This is kind of a trade station. I think it's slightly a data issue with trade station. But you'll see on this chart, this is the SPY. And this is a 5-minute chart of the SPY. Look at bar one. Bar one is, might be hard to see, but it's got a really, really big tail. That is not common. Normally, the SPY, which is an ETF of the S&P, normally it is very in sync with the Emini. I mean, almost to the tick. So to see a big tail form during the bar and bar one look like that, and often what happens, it's common on the SPY to get a really big tail after the fact. And I've seen that at least, I can think of 2 or 3 or 4 times where you'll get an example where bar one is a big bear bar on the bottom of my chart, but it didn't form that during the bar. This actually, I believe it went down and up. So just one, typically whenever if I'm trading the SPY and I see this and I see the E-mini do what it did on bar one, I will often just rely on the E-mini. When in doubt, if you're in situations like that, I'll also wait for a couple bars. But anyways, consecutive bear bars, probably always in short, but it's probably either going to be a trading range day. It's still not a big enough sell-off to make it a bull trend unlikely. Bar three, we have another bear bar with a big tail below, but now it's 3 consecutive bear bars. Probably sellers above and probably going at least a little bit lower. 4, we have a surprise bear breakout. So the bulls, they had a gap up. They tried to get a pullback on 3, and they wanted an upside breakout. But of course, after 3 consecutive bear bars, they failed, and the bears got a downside breakout on 4. 5 consecutive bear bars. It's always in short. I think it went always in short on 4. 5 is follow through, good for the bears, but it's a possible test of the bar 81 high. and it's getting close to an area where bulls got trapped. So, or where bears got trapped. Bears sold down here, scaled in, getting out break even here. 6, another follow through bar, but you have now 6 consecutive bear bars on the open, and you know at least 80% of the time there's a minor reversal every day. 50% of the time there's a major reversal every day. That means there's probably buyers somewhere below, and we're probably not going to form. In other words, I think we're probably going to pull back fairly soon. 7, it's not an inside bar, it's a bull bar, probably sellers above scaling in higher. Trading range day, sell off, deep pullback, testing the lows. So there might be more buyers down here than sellers. The bears want to break below yesterday's low. The bulls want to prevent it. 8 is a bull bar. It's a little bit of a surprise. It's fairly disappointing for the bears. With 7 and 8, the market's probably more likely entering the early stage of a trading range, and we may just go sideways more at this price level. 9, we have an inside bar, 3 consecutive bull bars, enough buying pressure. We're probably going to go sideways and may get a small second leg up. The bears still want a second leg down, but I think it's really hard to want to hold short when you see this kind of follow through. On the open, you always have to wonder when you get a sell climax if it's just a sell vacuum test of support, like the close of yesterday somewhere in this area. And if this is just a sell vacuum test of support, like the 6 low or the 7 low, we could easily just start to go sideways or even reverse. Low probability, we get an immediate reversal up. So even if we do break to the upside, we'll probably have to pull back and form a higher low. But for me, I think it's pretty dangerous to start holding short. Bear bar on 10. You can argue it's a low one short. Probably buyers below 10 scaling in lower. And the bulls prevented the bears from triggering it. 12, we have consecutive bull bars trying to break above bear flag, the low of, there we go, low of 7 to the high of 8. And we have obvious targets above, open of the day, the low of bar 3, the high of bar 4. If the bulls are really lucky, they'll get a bull trend day. But with the size of the sell off from 1 to 6, I suspect that there's probably limited upside. But on 12, I think 12 is a give up bar. And for me, the only thing I would consider on 12 is buying. I think as far as selling goes, I don't want to sell when you get a tight bull channel like this. There's too much risk of a deep pullback. 13, another bull bar, but getting near the price where bulls got trapped. The 2 low, the 1 low, the 3 close, anywhere in here. So 4 had a strong bear breakout, which means 4 traps traders. And because of that, that increases the risk that there's going to be bulls selling out of longs in this area and bears selling. But after 3 consecutive bull bars, probably more buyers below than sellers. And we get a bear bar on 13. But when you look at this, you can argue parabolic wedge, not all that clear, maybe 8, 10, and 13. But the channel up from 7 to 13 is so tight that it's a breakout on a higher time frame. And this is a pretty strong reversal. 16, it is a reversal bar. Bulls buy the close of 13, bought more below 15, scaling in lower, and they're deciding what to do here. Some bulls, they buy this close, 13, disappointed 14. And I said, this is 15. So some bulls, they buy the close of, let me do this. Trying to zoom in so it's easier to see the bar numbers. There we go. 15, testing the 13 close. Some bulls buy the close of 13. They buy more on the 14 close or below 14. And they're deciding what to do here. So there might be more sellers up here, but in general, it's a high one buy after 3 bull bars, probably going to go at least a little bit higher. And then 14, reversal bar. So it's technically 2 legs down, testing the 8 high. What about shorting below 16? I would not. The bears have not made any money below bars, And with the channel up being tight from 7 to 13 or 14, the odds are the first reversal down is probably going to fail. And then 17 is the doji bar, probably buyers below scaling and lower. What about selling above 17? There's probably sellers above 17. But again, my overall issue is the rally up to 13 is tight. So I think it's leg one. And whatever pullback we get here is the pullback. And this will lead to leg two. 18, surprise breakout, closing above several bars. Strong enough bar on 18, probably going to go a little bit higher. But the problem here is we had selling pressure in here, and that will increase the risk that there's more sellers up here and the market pulls back. 17 is a weak doji. It's a weak buy signal bar. So some bulls would sell. Some bears would sell above 17 and scaling higher. And that's what happened on 20. You can see 20 tested the 17 high, allowing bears to sell and scale in. 21 is an inside bar. It's always in long. Yes, you're getting close to the top of the trading range. The bulls are holding above the moving average, which is good for the bulls. I suspect we're probably going to have to go a little bit higher for the bulls. They want a measuring gap. And the measuring gap is the high of 8 and the low of 17 or 18. So this is the measuring gap right here. And then you can see 22 rallied up sharply and reversed. Whenever I see a bar, this is an example of an emotional bar. When you see a bar like 22 and it's racing up and it's not giving you a chance to buy, it's often better just to wait for the bar to close. And I get it. You look at the bar, it's racing up, and it's easy to become worried that you're going to miss the move. But the reality is, in a trading range day, you should always assume that the market's trying to do something to get you to enter in a bad location. So as this bar is racing up, I think it's more of a profit-taking bar. It's the best looking bull bar. This bar alone is 11 points. It's the biggest bull bar of the day, and it's climactic, breaking above the highs, and there's probably sellers above 1. So not really a good area to buy. And then 23 broke below 22 and sold off rather deep. So why would it do that? Well, strong enough sell off to 6 from 1 to 6 that there's probably sellers above. So some bears, they sell the 6 close. They sell more above 1. Maybe they sell more below this bar right here. So let me get rid of this measure move. So some bears, think about it like this. They sell the 6 close at, let's do it like this. Here, they sell the 6 close. They sell more below a bear bar here. And they sell more below this bar. And you can see break even was pretty much the low tick of this bar. It may have gone a tick or two below this low. And that happens all the time in a trading range. What about selling the close of 23? I would not. To me, it's a trading range day, type bull channel. And when you see a tail like that, especially following this bad signal bar here, there's probably more buyers below that bar than sellers. 24, reversal bar, testing the highs of 22. 22 is a big bar, and it was a surprise. This bar rallied, and then it sold off. It's kind of like a second leg trap. We had a second leg trap on the euro dollar. Let me just pull it up over here. Actually, the dollar yen. It was not the euro dollar. Here it is. So I mentioned maybe a couple weeks ago that the dollar yen on the daily chart formed a wedge. It formed a bear flag. And instead of getting the bear breakout, we got an upside breakout here, testing these highs. But it's a second leg trap. Leg one, pull back, leg two. And then this is the follow through. And then we went sideways. But typically, second leg traps, often they go sideways, even if they fall below the breakout. And then they retest the high close. And you can see look what we did today. We're actually breaking out above it, but we tested the close. And the reason I say that is whenever you get a breakout that goes several points above a resistance level or support, if it's a breakout to the downside, and bar 22 went several points above bar 1 and the open of the week, and it got really close to the high of the day. And there are bulls who bought on a 1-minute chart. So if we go to the E-mini on a 1-minute chart, we want to show this, we can see that it's right here. It's arguably 3 pushes up, 1, 2, 3. But what about the bulls that bought the close of 1018 on a 1-minute chart? And then 1020 is this bear bar. And the bulls, they were disappointed by 1018. So they buy, their entry price is 45.25. They're disappointed by the next bar. And they move their entry, their limit order to exit break even at 45.25. And look at this. And there we go. And look at the next bar, 1020. So what I'm talking about is here. Bulls buy, and they're disappointed with this bar. So what do they do on the very next bar? They try and get out, break even at their entry, the high close. It tested it to the tick and immediately turned down. Typically, when you do something reasonable in a bull channel like this and you buy a bar like 22 as it's going up, if a trader's willing to scale in and use a wide stop, they're probably going to be able to avoid a loss or make money. So here's a higher low, 24 bull bar. Some bulls will buy it, other bulls taking profits, and we drifted up towards the high and sold off. So you will have traders on 27 looking to take profits and sell up here, but the channel up from 24 to 27 or 28 is rather tight, so probably limited up downside. And then we went sideways for a couple bars here. $36 bull bar closing above a lot of bars to the left. The channel is fairly tight other than 22 and 23. And you know the market's in a trading range. So when you see a bar like 36, it's probably going to fail and lead to more sideways trading. But you always have to wonder, is this going to be a bull breakout of a trading range? In general, when you're in a bull channel, 75% chance that a bull breakout of a bull channel will fail, which means 25%, which means it's going to fail and pull back. When the market's in a trading range, there's about a 50-50 chance that the breakout fails when it gets near the top of the range. And what I mean by that is, yes, most breakouts fail in a trading range, but if the breakout is successful, 50-50 chance it continues. So whenever you see this, it looks like a bull channel, but when you look to the left, it's primarily a trading range. If you start getting closes above the range, you can have a lot of traders, in this case bears, giving up and the market can rally. So follow through 37. Is it always in long? I think so. It's not clear, but probably going to have a second leg up after 35, 36, 37. So probably buy the close and bulls scaling in lower. And then 38, a big bull bar, clearly always in long and buy the close. And when you look at that, just ask yourself, do you have any interest in selling? No. Maybe if you're long, 38 is a reason to take partial profits. But the reality is that's a strong breakout and traders are buying. Just look at the gaps. Bull bar, we gapped up on the next bar, and the low of the bar was the open. Another bull bar, we gapped up on the close of this bar, 37, and the open of 38. And you can see the low of 38 is 50.75, and the close of 37 is 50.75. So bulls, if they tried to buy the close of this bar and put a limit order to buy the close, they got trapped. If bulls tried to buy the close of 37 with the limit order, they got trapped on this bar as well. So it's forcing traders to chase the market. And that means there's a sign of urgency in the buying. Typically in a situation like this, when I want to get long and I see the market going up, I will enter at least a small position. Just get in the market, go to a 1 minute chart. It's going up. I just buy the market, do something, but establish a position, even if it's really small. $39, another bull bar, clearly always in long, probably going higher. Same thing with 40. Now the risk is getting pretty big, and the market's probably going to pull back. So we have 6-bar micro channel or 7-bar micro channel with 6 consecutive bull bars and pretty big tails, not really overlapping. Certainly a sign of strength. But with it being 6 bull bars, it's probably not going to go much higher before it starts to go sideways. Another bull bar closing on its high with 40. When you look at 40, what do you notice? To me, 40 is another bull bar closing on its high, and it's probably going to be climactic. So if you look at open gaps, we have the high of 36. Well, really, we have the high of 35, low of 37. We have the high of 36, low of 38, high of 37, low of 39. All of these are open gaps. We have the high of 39, low of 41, which all of that means it's strong buying pressure. And when you see this bar, which is 41, ask yourself, is the high of 40 going to stay open? In other words, what's the chances that the market falls below this red line? And I think it's pretty good. And that's why the market sold off and closed the gap. Still tight bull channel. Bulls will buy and scale in lower. But a lot of traders, if they bought the close of 41, they see 42. And some of those traders will say, yeah, it's a little bit disappointing. Maybe I should exit my trade at the 41 close and look to buy more lower. And instead, the market went up a little bit higher. So still buy the close. And some traders, instead of doing that, they buy the close and put a stop below a bar. And maybe they put it a point below the bar, maybe 2 points below the bar, maybe the low of the bar, and they trail. So they'll put a stop a point or two below this bar, a stop a point or two below. Other traders, they'll buy closes and they'll use a stop a minimum scalp distance below a bar. So if they deem that a minimum scalp is 2 or 3 points or 4 points, they'll put a stop 4 points below the bar. And the reason for that is if this is going to be a trend day or a strong bull trend ever since 36, the bulls really should not make money. And if they are making money, it's probably transitioned into a trading range. 42 is a warning. It's a doji. It's a trading range bar. And because of that, it increases the risk that we're going to get back to the 42 close. So I'm going to go ahead and mark that just as a reminder. We'll talk about it later in a minute. So here's basically the middle of 42. I'm going to make it blue just to stand out. So the odds are we're going to get back to this at some point. Bull bar 43 follow through, but again, fairly climactic. This is probably more of a profit taking zone than a zone to establish longs. And you can see, if you look at the moving average, it's getting further and further away. So if we take this line, then we take another line, you can see it's kind of hard to draw it, but what I'm trying to paint is you can see up until this point, it's forming, kind of like a triangle, if you will, where you're getting, it's parabolic is what I'm trying to get at, is it's going up and the moving averages going further away, and eventually this is going to stop happening and we're going to get closer to the moving average. That was just more to illustrate a point. We're far from the moving average and we're probably going to retest it. 45 bear bar, probably buyers below, scaling in lower. But like I said, what about 42? This is probably a profit taking area. Second leg up from the breakout on 40, 47's a second leg up. Traders buying, scaling in, getting out. 48 follow through. But I think after 45 and 46, more traders are going to take profits above the 44 high. 49, another strong bull bar. So more traders buying. But at this point, here's the breakout above 42. We rallied above it. We pulled back below the breakout. Here's the breakout of 44. You think we're going to pull? How far do you think we're going to go before we test the breakout point? I don't think we're going to go that much further. And then on the very next bar, we tested it and closed it. So best looking bull bar of the rally on 49, and everybody used it to take profits. It's real similar to 43. 51, testing the 49 close. Bulls buy the close of 49, disappointed 50. They get out, break even on the 51 close. 52, we went a little bit higher. So now we're forming a little bit of a parabolic wedge, rally to 47 or 48. So you could argue like this: rally to 47, pull back 48, rally to 49, pull back 50, rally to 52, or rally to 45, pull back, rally to 49, pull back, rally to 52. Bear bar closing on its low or near its low on 52, probably, or 53, probably not going all that much higher. And then 54, we have a high one buy. In general, high one buys are great in a strong bull breakout. Even a bar like 46 is a high one buy. And you can see traders clearly bought above it. 54 is more of a tight bull channel, and the market's starting to get overlapping bars. Therefore, there's an added risk that there might be more sellers above 54 than buyers. And that's what happened. The market triggered the buy above 54 and immediately went down. 55, a little bit of a surprise, probably going to go a little bit lower. But do you sell the close at 55? I would not. Just look at this channel. It's pretty tight. I think the better thing that traders should do is wait for a couple of legs down and then look to buy. But I would certainly get out of longs below 55. 56, another bear bar. Consecutive bear bars, probably a small second leg down likely, but there's probably buyers not far below, maybe at the 46 high, maybe the 50 high, 50 low. But again, doji, we might get down here. At a minimum, I think we're going to get to the moving average. And then we bounced on 57. So you can see bulls bought the 50 low during 56 and we bounced. And then 59, you can see bears sold the close of 56, disappointed 57, tried to get out at break even at the low of 58. I said 59. I really meant 58. Still probably sellers above 58. At this point, I think we have to get closer to the moving average. 60 bear bar, and then 61 breaking below the moving average. Consecutive bear bars, 60, 61, probably going to go a little bit lower. 62 bull bar at the moving average, but to me, I think this bull bar on 62 is more due to bulls trying to sell out of longs who bought the 60 close or the 60 low than it is eager bulls trying to buy above 62. And then 63, we have a bear bar. Low one, short 62, probably buyers below, scaling in lower. But again, blue line, possible target. 64, outside up. What about buying above 64? You can, but it's a fairly tight channel since 68, and that will limit the upside. 69 or 65, bear bar closing on its low. 66, another bear bar getting close to the target. And then you can see we came really close to the middle of this bar and reversed up. And that's what I talk about. I've talked about it in the trading room. For those that are in the trading room, I've talked a couple of times about it, but doji bars are magnets for traders. And the same thing with tails. There's support levels, the resistance levels. A doji bar is an area of agreement, two-sided trading. The market went down and up or up and down. Hence, that's why it created a doji. And it will be a magnet later in the day. So that's in part why the market turned up. Some bulls, they buy above 64. They buy more below 64. And that's why this is happening. And they're deciding how to manage the trade. Do they get out, break even on 67? Do they hold? And you can see, even if you're a bull, if you bought the close of 64 and bought more at the 64 low or lower, you got out and you had the chance to get out break even at your original entry. 69 is 3 consecutive bull bars, probably buyers below, but the channel down to 66 is rather tight. You can call it a wedge, 56 and 61 and 66. So probably buyers below 69. But whenever you have a tight bear channel down to 66, I always am worried if the sell off to 66 is the first leg and the rally to 69 is the pullback, and we have to have a second leg down to the 66 close or the 67 low. And we went outside up on 70, and you can see what happened. There were bulls that bought the 59 low, and they got trapped on 60, and they never had a chance to get out break even. So some of those traders, they buy the 59 low, they buy more lower, and you can see this is where they decided to get out. Surprise breakout on 71, probably going to go a little bit lower, but it's testing the 66 close, and we're probably not far from an area of agreement. So for me, I think the issue with selling here is it's forcing you to sell and risk about 6 points. And to me, it's really forcing you to risk about 8 points. And to me, I don't think we're going to go down 8 points before we rally 8 points, especially after 4 consecutive bull bars and what's more likely a trading range than a start of a bear trend or an endless bear pullback. $60.72, a doji, and then 73 bull bar pulling back. So you can see bulls, they buy the close of 71. They made money during the rally on 73, so more disappointment. And we pretty much went sideways into the close. You can see the bulls that bought the 60, 70 low and scaled in made money. For stop entries, I think it's okay to sell below 2, and if you're hoping for a trend from the open. But what do you do on 7? Do you get out? Some will, or they'll get out 3 or 4 points above 7. Other traders, maybe they get out above 9. They certainly have to get out above 11. Bulls buy above 11. And what about selling below 14? I would not. What about buying above 18? You can, but you're pretty much in a trading range, so probably going to get a lot of overlapping bars. And then in here, maybe you buy above 24, betting on a second leg up. But if you do you get out below 28? Micro channel since 23, so arguably you don't have to. But I think it's okay to exit below 28. And then 33, 34, 35, forming a triangle. Some bulls will buy above 35. Low probability, but if you're doing that, you're betting on an upside breakout. Other traders buy above 36, or they wait till the 37 close. And for stop entries, other than that, it's really not all that clear. Maybe you buy above 67, but tough to do. If you buy above 67, I think you get out in here. Too much risk of a downside breakout and a test of the 66 close. And that's all for stop entries I would do. For limit orders, sellers above 3, but it didn't trigger. Probably buyers below any of these bars. What about selling below 6 or selling above? What about selling above 6, 7, or even 5? Probably okay. And you can see a lot of those traders did that, and some of them got trapped. If they were really quick, they sold above 7, scaled in, got out on 9, back on at the 7 high. buyers below these bars, and buyers back at breakout points, buyers below even 22. Tough to do. 3 pushes up, 1, 2, 3. But bulls bought below 22, scaled in, made money. Buyers below these bars, but again, tough to do. Top of the range. And then next buy the close, sell the close, probably buyers below 45 and buyers below 49. What about selling above 54? You can do that, but I think the problem with selling above 54 is it's it's probably okay. 3 pushes up and tight, but it's tight channel, so really difficult to do that. Buy the close, sell the close. Sell the close on 4, sell the close on 5. Arguably sell the close even on 3. And then if you sell the close at 6, you just take the loss on probably 8. Buy the close of 8, maybe buy the close of 9, maybe probably buy the close 12, but getting high in the range, probably going to go more sideways. So a lot of traders that buy 12 will scale in and scalp out. Buy the close 27, maybe, but you know that bulls who bought the 22, the rally during 22 got trapped, and they may use 27 to sell out of longs. Buy the close 36, maybe aggressive. I'm 29, by the way. Someone just asked. 36 is a bull close. Probably okay to buy the close. Better to wait for follow through. 37 consecutive bull bars. Buy the close, and then really buy the close on any of these bars as long as you can trade small and use a wide stop. Typically, when I'm buying closes like this, I don't have a stop down here because for me, I typically don't want the market to fall a measured move of the signal bar. So if I'm buying a close like 41, if I buy the close of 41 and put a stop, where would I put a stop? In general, I'll use a size of the signal bar. If it's a good signal bar, I'll put it maybe a measured move down and maybe a little bit lower, but I'm certainly not putting it down here because if something happens and stops me out suddenly, if the market sells off too quickly, I just want to be out. And really buy the close anywhere in here, even buy the close of bear bars. And what about 55? Is that buy the close, sell the close? I would not. And then in here, it's a trading range. So bear bars, it's probably more buy the close than sell the close. Bull bars, probably more sell the close. But really tough to sell the close of a bar like 64. If anything, if you're buying above 64, you're probably buying the close and then buying more below 64. And in here, trading range, so it's the opposite. 69, probably more sell the close. And then big bear bar on 71, probably more buy the close. But I'd really stop trading in here. Okay, I'm going to review the questions and start answering them here in just a second. Okay, let's take a look at questions. Did you buy between bars 36 and 44? Yeah, let me just talk about what I did. I sold the close of, I didn't take that many trades today. I sold the close. Let me just hide the question. I sold the close of 4, scalped out. I made a mistake and sold late during 5 and was too slow to exit. So I ended up selling the close at 5, and then I scaled in once or twice during 8. 8 started to be a little too big. So right before 8 closed, I ended up just reversing my position and ended up getting out, I want to say around the 3 low during 12. And I don't remember what I did here. I know I bought once and bought more. I just don't remember where I got out. Okay. I bought again on 12, bought more lower, and got out as 18 went up. So pretty much at the high of these bars. I bought, scaled in, got out at the highs, and I ended up buying near the close of this bar higher than I wanted to. I bought more around the low of 22 and maybe once more lower. I can't remember. And then I took part off around the open of the day. So pretty much above this bar on 26 or 27. And then I took a chance that we would rally pretty strong. And then as 27 went up and then 28 went up and started to stall, I got out of that last position. And then I believe my last trade was, I believe I bought the close at 38 and scalped out. So I actually stopped watching most of this in here. I had other things I had to do. So I missed the rally, but that's okay. The goal with trading is to take reasonable trades. And it's not to take everything or do everything, every possible trade. It's just to do the right thing with the trades that you do take. How can a strong bull trend come from a market that has so much confusion? Yeah, because when a trading range breaks out, you often get you get trapped traders. So a good example is today. We had a trading range from anywhere in here, this basically whole area. And then 36, 37, 38 is a strong breakout. And it's breaking above the range and that it's probably going to go higher. Sold below 2, got out above 9. So sold below 2, got out above 9. Yeah, I think that's a good trade. Is there a better way to manage it? I don't know. I think it's okay. At 9, I think it's fair to say on the close of 9, something's wrong with the bear case, especially with the logic that you get a lot of opening reversals in the first hour of the day. I think that's good management. On the daily chart, if we get 2 to 3 strong bull bars breaking out of the current tight trading range, so if we get 2 or 3 bars after this breaking out of the current range, what's the chances that we reverse back? Sure. If we get a breakout and then a follow through bar and then a bear bar closing on its low, traders will say it's a failed breakout of May the 1st. That's why, again, show me the follow through tomorrow. If the bulls are really strong, we'll see it. Is predicting a pullback possible after a strong leg? Do we know how deep the pullback will be? Well, that's the question. Yeah, do we know how deep it's going to be? I suspect this is disappointing enough that traders will see this as a trading range. So even if we rally up to here, maybe the high close 54, there's probably more sellers up here, and we're going to spend more time going sideways. Question: how do we know when to scale in versus exit? Exiting on 2 big bars on range days or exiting on reversals. Day started as a range day, but scaling did not work. Well, you have to be able to understand when the market is in a trading range versus a trend. A trend traps traders. So a strong breakout, it's kind of like this. I mean, let's take the trade I took on 22. I bought during 22, got trapped, bought more, and I was able to avoid a loss. I was actually able to make money on the trade because I figured the day was in a trading range and I thought the rally from 7 to 22 was strong enough that we'd at least go sideways, but it had a very wide stop and I was trading very small. When you get a bar like 20, 36, 37, 38, if you're a bear, there's almost no way you're going to make money. You're just going to get, you're going to get totally screwed selling. And in here, it's not so much the case. If you sell the close of 12, you were able to get out on 15. If you sold above 15 and scaled in, you were able to avoid a loss. Even if you sold the close of 6 and sold more below 14, you avoided a loss on 23. That is the difference. So you have to learn how to see when the market's actually breaking out versus when the market's in a trading range. And one of the ways you do that is, what really worked for me, I started trading something like the SPY and trading really small, and I would just fade everything. So I'd buy below bars, I'd sell above bars. I would do really well in a trading range environment, but then I would get trapped on bars like 36, 37, and 38, and I would just get obliterated. And I had to realize that breakouts destroy limit order traders. That means as long as I can figure out when is a breakout strong enough to get a second leg. It's like Al's first book. If you go to one of his books, it might be in all of them. If you go to the introduction pages of the 3-volume series books, you will look and you'll see one of the, I don't remember the quote exactly, but he said the single most important thing a trader can decide or understand is, are there more buyers or sellers above and below the bar? What he's saying is, what's the probability of a breakout? And that just takes time. My screen went away. There we go. How many years do you lose before you're able to trade profitably? Yeah, I'll talk more about this just kind of in generalities more than anything. But I think it takes a long time for traders to figure out what they're doing. And the longer you trade, the more you start to learn, the more you evolve as a trader and grow. And that's why it's a lot of fun. When you're starting out, trading is very, very frustrating. And I totally get that feeling. I've been studying now since probably mid to late 2012. So it's safe to say I've been studying Al for pretty much 10 years, maybe 11 years. It might be 11 years come this June. So June, I believe, is the 11-year, just about the 11-year anniversary of me studying Al. And that's pretty surreal to think about. But it's kind of crazy when you think about all the little things you learn. And what's interesting about trading, I wish I could draw it, but if you can kind of follow my mouse. So everyone's heard of the hockey stick analogy with business, where you start a business and it's kind of like an inverted hockey stick where the revenue's flat. And that's kind of like your trading production. And then all of a sudden, in the latter years, if it's successful, it all of a sudden starts to maybe go up and then it starts to be parabolic. And that's kind of the same thing with trading knowledge or your understanding about the market. The problem with trading is it's kind of like it's like being a professional athlete. You're either, another way to put it, if you go to Al's book, he said anyone can play soccer, but can you play soccer well enough to make a living from it? Can you play soccer well enough for fans to pay you? Anyone can play an instrument, but can you play it well enough, or sing well enough to fill an audience or fill a stadium? And with trading, it takes a long time to get to the point. You have to be proficient in so many categories, but the longer you study, the easier it is, and you start learning things. You start learning lots of nuances. But everyone's journey is different. For me, I was pretty stubborn. I spent a lot of time. I've got to pay attention to the clock a little bit, but I can talk for about 5 or 6 more minutes. I spent a lot of time in Al's trading room really studying Al. And, if you really want to see this, I'll just show it to everybody because I think people should see this. And give me 1 second. I will pull it up. So this is remove this question. This is a file of Al Brooks' webinar backup, and I haven't backed it up in a while. But if we go to the naming, the dates of these, you can see here is 2013 of August of 30. And if I keep scrolling, here's 2014. And there's 2015, 2016, 17, 18, 19. I think there's even 2020 and various ones. But the point is, there's, almost 8 or 900 videos in there. And the reason I bring that up is you just accumulate a lot from studying out in the trading room. That's what probably helped me the most. And anyways, to go on, I forget where I'm kind of going with that, but the point is you spend a lot of time studying. That is the key. And everybody's path's different. I tried to be like Al and really figure out the scalping piece and figure out swing trading. Is there a better path? Probably. But the first key is just really spending a lot of time studying. Let me look at some other questions. Is buying 11 a good buy? Yeah, I thought 11 was a reasonable buy. To me, I thought I was long during 11, but my thought with 11 is it's kind of screwing the bears. If the bears are short and they're looking for a pullback, and they know the pullback is going to either be a bull break, it's a flag. So the bears want a bear breakout, and the bulls want a bull breakout of the bull flag. And the problem with 11 is it increases the risk that the bulls get the upside breakout. And by the way, in the trading room, when I'm in the trading room, there's a lot more time for us to discuss questions. It's hard to get this all in an hour. How would you trade the last 2 hours of the day? Pretty much what I've talked about. I would just buy if I was trading in here. I see a bar like 38, I would buy. And really, you can buy and scalp and just continue to buy all the way up. But if you buy 38, there's really no reason to get out. You can get out below 45, but even 45, do you really want to get out below 45? The bears haven't made any money below bars, which means the first reversal down is probably going to fail. So probably buyers below 45 and going higher. And in here, once you start to get 2 or 3 legs up and you've been far from the moving average, I'd just get out below any bar like 53. High one buy above 54. I mentioned it's a bad buy. So traders even sold to sell out of longs above 54. Other thing, when you're studying Al in the video course, take lots of notes. I went long with a stop order above 9 here and added above the range. Yeah, I think that's okay. Buying above here and holding for a swing is probably okay. How am I supposed to enter this bull trend? I was waiting to get a pullback in one of the resistance higher in the higher time, and you saw the resistance in the higher time frames, but it didn't happen. I always miss opportunities on days like today. Yeah, go back to the trend videos in the video course. The key with getting in here is it's like jumping off a high dive. You see 38, you just have to buy and put a stop down here and trust it's going to work. For me, I really like trading Forex or something like the SPY, because for most traders, they should do that because they can trade very small and use a wide stop. They can buy 5 shares and virtually have no risk and realize that if they just buy, they'll make money. That takes a long time. Do you maintain a trading journal? Not so much right now. I do but what I am doing these days is making a lot of PowerPoint slides. So, I'll even for some of the slides I'll make, it's often thought through maybe a mistake. So for me, why I created that PowerPoint slide at the beginning of this presentation or this video that we were doing or live stream. The reason is I went short down here. I should have remembered that we had a gap up, which means the odds favor a second leg. So it was higher probability that we would bounce, which means after 6 bars down, I should have been quicker to get out above a bar like 7, or even wait and sell a pullback, which means I really shouldn't have been short in here and gotten trapped. But I created a PowerPoint slide on that because I'll remember it and I can study it later. Someone said they liked the trading room. I'm glad that that is very helpful. How do you speed up the learning curve? What would you suggest? I think the key is you have to look at it like this. And this is something Al, I'm going to speak for Al because that's the only person I've ever studied really with trading. But Al is 30 years. When I started studying Al, he started trading in 87. So he's 30 years into the experience of trading, at least by the time I started studying him. So when I started watching the video course in, 2014, 2015, 2013, somewhere in there, and reading the books and listening to him in the webinar, I'm trying to, if you think about it, you're trying to grasp someone's 30 years of someone's information. That's like, that's like if you're a big basketball fan, it's like trying to, have LeBron James or Michael Jordan teach you how to play basketball. And, they're at the top of their, the pinnacle of their career with it. And it takes a long time to grasp all that. I mean, if you're studying Al's material, you're kind of getting the highest, I would say the highest trading degree you can get in education. I mean, you are learning, it's 100, if you just look at the video course, it's over 100 hours. And that is a lot of information. Even the books, they're 500 pages. There's 3 books, almost 500 pages in each book. So that's 1,500 pages of pretty in-depth information. And that just takes a long time to learn. But that is, if you do it day by day, you eventually get there. Did you start with options or futures? I started with futures, but again, there was someone I studied for like a month. I don't remember the person's name. And then I found Al's book, and that's really how I got attached to Al's material. So I don't know if it helped me. I believe it did. For me, I didn't really know. I knew the very most basics of trading when I started studying Al, but I really knew mostly nothing. And ever since then, Al is basically the only person I've ever studied. So to me, I think it's important to, it worked for me. I didn't study a lot of people when it came to trading. I just focused on Al. So for me, when I was studying, when I was learning to trade, when I was really focusing, it was either, if I took what Al said and believed it to be true. And part of the reason I really began to believe it was true is listening to him in the trading room. I'd hear him say something, we're rallying, and he'd say, okay, be ready for a breakout. If we get it, it could be fast. Or he'd say something like over here, 18-bar range, we're probably going to break above or below it, and we could do it very late in the day. And the longer I listened to him, after a year or two of listening to him, I'd say, wait a second, what he's saying is actually happening. He really does know his stuff. And it just increased my confidence in studying Al. Okay, so it looks like that is all the time I have for questions. So as always, I hope this was helpful, and we will see what tomorrow brings. Hope everyone has a good one.